Well, hello and welcome to Trading Blows, our final show of the year, and it's a busy one with plenty to discuss. Myself and the panel will digest some of the US economic releases we've had over the last couple of days. We'll also look ahead to the central bank bonanza, which kicks off with the Federal Reserve a little bit later on. And of course, as the year draws to a close, it's a good time to look back at some of the key driving forces of the financial markets over the last 12 months and also ponder what the year ahead may bring. Without further ado, let's get into the show. So a lot for us to discuss this week. It is silly season in the financial markets, and given it's our last show of the year and Ryan Paisey is here, I think it could be silly season on Trading Blows as well. Joining Ryan from PiQ Suite is Ioan Smith, a market veteran of the sell side and his own research firm, and Arno Venter, the market analyst and founder of Capital Edge. And for Arno's benefit, Christmas songs are banned from Trading Blows today. It would bring back some sort of PTSD for him, so we will avoid that as much as we can. Right, with the gents now with us, let's get on with the first round. So before we get into our 2023 recap, 2024 look ahead, getting the crystal ball out, let's have a quick look at some more recent developments. We've had a couple of important releases out of the US over the last 3 or 4 trading sessions. Obviously, we had the hotter than expected labour market reports on Friday, and then we had the inflation data, the CPI figure on Tuesday, which was pretty much in line with expectations. So plenty to digest. Ryan and Ian, what are your thoughts on what all this means? Does this really tell us anything that we didn't know already about the US economy?
No, not really. Firstly, can I just say a big congratulations to Michael Brown for completing his MBA?
Thank you very much.
Hey, congrats. Well.
Do I get a point for that? Yeah. I don't really care.
I will give you a point for that. I'm going to go and get a bottle of champagne as well.
But also, Merry Christmas, Happy New Year to everyone who observes. To answer your question, does it tell us anything extra? No, not really. We keep saying about soft landings. I'm still in the no landing camp. Everything I hear or see points me in that direction. People getting very frothy over a tiny uptick in the CPI. One, it was expected. Two, if anyone believed it was a straight line going down, then they want to be in the nutty farm anyway. It was never going to be a very smooth kind of just tick off. We were always going to get a couple of bumps. Just base effects alone. We spoke about in the past on previous trading blows that we're now getting into the point where the base effects are starting to work against inflation, work against the kind of the erosion of the inflation or disinflation, or whatever you want to call it. I'm losing the will to live this year, to be honest. But yeah, so look, it's not going to be a straightforward path. It will have kinks in it. Don't listen to anyone that's getting all frothy that's saying, this 1/10 of an uptick or 10 basis points uptick is signs that it's all turning. Is it bollocks? It's just one of those things. I think, most data since the November FOMC has pointed to a moderation in activity and disinflation and cooling labour markets and everything, which is exactly what we wanted to see. This remember that, money's not been this tight for quite some time. So, things are going to, kind of pop up and scare people. But no, in general, I think this is kind of quite an easy question to answer. It's as expected, as you would expect. Obviously, we got FOMC tonight, but we're coming on central banks later on in the next segment. Yeah, not really much more to add, to be honest, mate. It's kind of playing out as we kind of I think the three of us have predicted for the last 6 months. Obviously, I'm not saying that we've called the markets right, but we've had, there's a big difference between doing that and but yeah, in terms of how the data's played out, I think the three of us have all been kind of on this and just said, look, we are going to see moderations, we are going to see disinflation, we're not going to see a hard landing, and that's exactly what we're seeing. Doesn't mean I can pick a winning trade though, but
Yeah, no, I very much agree. And it was an easy question. That's why I went to you first. Ewan, I'm keen to bring you into the show. It's been, probably about 6 or 7 weeks now since we last spoke. I mean, has your view on the US economy or on the global economy evolved or changed at all since then?
Yeah, it's like you said, 6 weeks. I've had a mustache and got rid of it.
Mate, I haven't had a shave since the first Trading Blows.
And I turned up for Ryan's birthday party.
He did. He said, I didn't know it was him at first.
He said he thought he was Ned Flanders.
Oh, God.
Yeah. Anyway,
we digress.
5 minutes is all it took.
Oh, the wheels have already come off.
Yeah, like you said, I think things are generally slow moving, especially in when it comes to central banks at the moment. Everybody's obviously fixated with the inflation side of things, but I don't know. I think ultimately, from a Fed standpoint point of view, I mean, we know that the inflation's easing. I mean, it gives Ryan a chance at every stage to pull out his car chart, which shows that the car is still moving.
Oh,
that famous.
I was really worried for a second there.
When he said pulls out, I was like, hang on a second.
Just move on. Just carry on.
I mean, like when we talk about soft landings, hard landings, things like that. From a trading point of view, I don't think it matters so much. I mean, you're still going to trade regardless of the economic conditions.
Still going to lose money,
right? I mean, you do, right? Because it's. Yeah. We've all been doing it for decades now. So and we've done it through multiple recessions. So it's if anything, those type of periods give you more opportunities to trade. But going back to the inflation standpoint, I think interestingly that from the November CPI, I think the 3-month annualized rate did drop to around 1.6% from 4% on the previous 3 months. So big picture, goods prices have been falling, but again, that's due to a drawdown in inventory accumulation. I think the next stage that I'd be looking for next year, especially in the US, and for any potential pivot point for the Fed, will be that drop in shelter costs, which should come in at some stage, you would have thought. But at this stage, I don't know. I mean, I always used to be of the opinion that when the central banks have moved this quickly, just to give themselves a bit of room to maneuver during any sort of recession. I mean, central banks, they're not predicting a recession; they never will. But at some stage it will come. I mean, the expansion is, one of the longest in history, but it's also one of the weakest. So there's a lot of underlying data that points to general weakness, which we'll go on in some of the other topics that we're going to discuss today. But I think ultimately, is there enough to justify, the dovish repricing next year? I think there's a good chance, as just a good chance as, there'll be more rate hikes than there will cuts. So,
well, there you go. Music to the ears of Richard Matthews on his yacht in Monaco or wherever he is this week. The fact that we may get hikes again. Arno, what are your thoughts? I mean, I'm assuming you're pretty much in line with the consensus here. This is all pretty much bang on what we expected at this point. The jobs market bumbling along okay, inflation coming lower, nothing really to worry about, right?
Yeah, I would say so, mate. I mean, right now, like we've been saying over the past few weeks now, there's really nothing in the data to suggest anything other than a soft landing right now. Like Ryan said, the labor market is slowing, but it's not collapsing. I mean, 3.7% unemployment rate, it's still, yes, it's slowing, but it's still super tight. There's no concerns there. Growth is expected to, and this is important, is expected to moderate next year. Going from 5% quarterly down to 3%, yes, that's big moderation, but it's still solid growth. So it's not like, things are collapsing by any means. I've been saying this for a while now, and I still hold to this view. I don't think the magnitude of the dovish repricing we've seen recently is is accurate. If the view is that we are going to get a soft landing, no landing, bottom line, the economy holds up okay. I don't see why the market has this infatuation with cutting rates so quickly. I get the idea that, okay, we should cut now to try and avoid something bad later on. But central banks, they don't react that way. Look at how long it took them to hike rates when inflation was skyrocketing higher. So I think they give themselves enough time. If you take a look at some of the cuts priced into as early as March, April, May, if the view is a soft landing, I just don't buy into the cut or the dovish repricing expectations right now. I just don't see that happening, not as early as the markets have it right now. I could see them cutting rates sometime next year, but probably closer towards Q3, Q4, especially if the economy holds up. I don't see the reason. If everything is going okay, I just don't see why the market is holding up to such a strong view of this dovish repricing. It feels a little bit overdone at these levels.
Well, I think it's just that classic thing, isn't it? Sorry, Ra, I was just going to say, it's that classic thing where markets underestimate the tightening cycle and then overestimate the easing cycle. We've seen it countless times before.
Could you not also say that maybe it's that what we spoke about many times before, where people have almost kind of got it in their heads now that you cut when things are okay, because people's kind of mental state on all this has got so bizarre. It's like, things are going all right, so let's cut rates. Well, people have forgotten that you only cut when things aren't going well. So I think there is almost that bias on that side as well. I know it sounds really weird, but maybe not for the experienced traders, but for newer traders especially, it feels like, oh yeah, cut rates, things are going all right. I'm like, no, that's not how it works, mate.
Well, central banks are not that reactive anyway. They're not that progressive, right? So in theory, it would make sense to cut rates when things are going well, just so you could just keep that momentum. But ultimately, they don't, right? So they wait. Exactly. They just react. They're not proactive. They're reactive.
And that's that thing, isn't
absolutely.
It? It's hike when you can, cut when you must.
That's exactly the way to look at it. Right, we are going to get on to the second round and dig into central banks in a little bit more detail. I really regret not asking Kyriakos now to change the little inter-round music to, I don't know, Mariah Carey or something like that, just to wind Arno up, or a bit of Slade, one or the other. In any case, it is a busy few days of central bank decisions coming up. The Federal Reserve on deck this evening. That probably will have been passed by the time you watch this, depending on how quickly this video is edited and uploaded. But then we've also got on Thursday the European Central Bank, the Bank of England, the Swiss National Bank, and the Norges Bank. And then, of course, we've got the Bank of Japan coming up next week, which I think, correct me if I'm wrong, is the final G10 central bank decision of the year. And there's a whole bunch of EM policy decisions in the middle of all of that as well. Ioan, let's start with you. Out of all of that lot, and maybe even one that I didn't mention, which do you reckon has the most potential for a surprise?
I mean, there's so many, right? But I think none of the central banks are, expected to change policy at this stage. I mean, it's not like it would do much into the new year. I think the closest call is probably Norway. If you look at the swaps market for the Norges Bank, it suggests that their tightening cycle is still not over. And headline inflation is still ticking higher, so they would be the most likely of any central bank. But I don't foresee any major event that you can trade. I think you've got to remember that at this time of year, the market's going to be very noisy. It's very easy to get sucked into all these different narratives, but you just got to maintain your discipline. I think the Bank of England might be quite interesting, not from obviously the headline release, but I think, as Ryan alluded to earlier, that the base effects, are starting to come out. Especially in the UK, we had that energy-induced spike last year, so they're all starting to drop out of the calculations. And the headline rate it's still a massive 4.7%, but it did show the steepest drop in about 30 years. But I think the bank's own inflation survey themselves, I mean, they've shown that household expectations for next year's has dropped to 3.3%. So that is a 2-year low. But ultimately, I think the Bank of England now, their problem is the labour market. Like Mike, as you've done, alluded to before, you've shown a dartboard when it comes to like the labour market calculation. So I think if you're going to do anything which is tied to what the BOE say, is then you get long dartboards, right? Because you have absolutely no idea what the ONS are doing. I mean, I've been unable to provide any sort of monthly, labour market report. And it baffles me how they can run a business like that.
Analysts, mate, they get paid for whatever they say.
Well, I was going to say, I don't want to interrupt you, but I'm going to, just to put a bit of context on how shambolic they've been. The officially released unemployment rate, which they haven't released for about 3 months now, over the summer, over Q2, that was pinned at, I think, 4.2%. Or 4.3%. They've then gone back and redone it with this new experimental methodology that they're using. Yeah, massively. And this pains me, but I need to give credit to the FT for finding it. It turns out that unemployment in the second quarter was actually 3.5%. Now, how on earth anyone, one, can trust what they're saying, and two, how anyone can make policy based on that is just laughable, to be honest.
Well, exactly. I mean, so the Bank of England themselves, I mean, they said that the employment data could be out by as much as 1 million.
Yeah. I mean,
wow.
But again, it's like, how can you dictate policy when you are like, where you've got no idea what the conditions are like? If you got to, essentially say that, the conditions are gradually easing. We probably know that, right? Mm. And there's a decline in vacancies, which, did hit a 2-year low in, that's probably a parcel for me.
I was like, oh, hello.
I was wondering where that was going.
His marital aid just switched on. Sorry.
Oh God. Oh no.
Red. Yeah, we won't go there.
I was just like, no, restore some order for us, please. Could any of the central bank decisions this week be a surprise, or are they all just going to be a damp squib and we put our feet up for Christmas?
Yeah, basically. No, look, I think we can have a few surprises. Well, not really surprises, just let's call them mini surprises, if we will. I'm not going to talk about the FOMC because they're going to be out of the way by the time that everybody watches this. But I think SNB will be quite interesting this week. We know that the Swiss franc has just been incredibly strong over the last couple of quarters, and it hasn't really been down to the fundamental outlook for the Swiss franc. It's really just been down to the SNB that's been selling off their foreign reserves and propping up the Swiss franc. They've chosen to fight inflation by using currency strength, and so far it's really worked. I mean, we had inflation surprising massively to the downside last week, Monday, for Switzerland. We came in at 1.4% on both the core, slightly below 1.4%, for the core, and on 1.4% for the headline. Now that's massively below their just below 2% target. So if you just put those two things together, I think they're weird, they are so frightened about inflation that they think might come in 2026. I'm like, really? You couldn't even forecast it correctly 2 years ago. Now you want to try and set policy going into 2026. It just makes no sense. I think the recent data has shown them that they don't have to worry about that, fear about inflation coming on, medium-term sticky inflation. So I think there is a high likelihood that bank can potentially drop that FX intervention policy of theirs. And if that happens, we basically just need them to step out of the way. And I think the Swiss franc can see some downside in the short term. There's a couple of different ways you can look to play it. Euro Swiss franc comes to mind, dollar Swiss franc, especially with the FOMC, especially if the dots, show something a little bit more aggressive than what the markets are pricing. The other one that, I hate talking about the ECB, but I'm going to have to. Look, things aren't great. Inflation is low. Growth doesn't
Understatement of the year from Arno.
He's got $100 a month Substack coming out saying all that in a minute.
We know things aren't going well, but I can't see these guys cutting rates in March already. We've had a couple of ECB speakers recently. If you take a look at the last 2 weeks, a couple of them have literally come out directly saying it's way too early to even talk about cuts. It's premature to think about rate cuts. You're too optimistic about rate cuts. So if there is going to be a wild card tomorrow, it could be the ECB, where they actually, if Lagarde can nail it with the comms, which is going to be, quite a tall order for her. But if she can get it right, if she pushes back a little bit against that, maybe that can create some upside for the euro. But that's pretty much that. I'm not expecting much from the Bank of England. Markets are expecting them to push back against cuts. And I think if they just do that, that's pretty much in line with the expectations. So possible mini surprises I'll look at is if the SNB moves away from their FX intervention policy, and if the ECB tries to push back against cuts. Again, Lagarde will have a work cut out for her, but that could be something that's worth watching.
Indeed. Right, Ryan, if you can behave yourself for 30 seconds. I'm sure you'll be glued to your desk for all of these central bank decisions.
Yeah, massively, mate. Just to follow on with what Arno said. Yeah, I agree. I would love to see Lagarde push back. But in regards to the other central bank shenanigans, obviously, as you all know, I'm a bit of a fucking idiot. So I will make a prediction on the Fed, even though you're going to view this after the event. So I've got nothing to gain from it. I think we'll see the initial steps of changing the communication from the hawkish holds to a dovish hold. We're getting that way, basically. I think in terms of the ECB, I think it's, again, as Arno and Ioan said, they're not going to be doing anything ahead of Christmas, New Year. Why would you? You've not telegraphed it. Also, that the markets, well, your core markets, as in your STIRs and stuff, liquidity's gone since NFP on Friday because, the big desks are, they're at home and enjoying their Christmas break. I think that's a very important thing to remember when, especially for retail traders, the volume and liquidity now until the new year will be absolutely dire.
Yeah.
So the ECB, they're not going to do anything. Q1, they're going to cut, in my opinion. Regarding the BOE, I think yields are telling you everything you need to know. We had some poorish data today, or at least missing estimates. So yields collapse with the increased chance for BOE cut, but that doesn't mean they're going to cut right now. Again, they'll probably cut. Well, if they are going to cut, it will be after ECB. You could say EU dragging the UK down. I didn't vote Brexit for that, but there you go. That's why I've wanted to leave. Anyway, we're getting political. Where's Matthews when you need him? In terms of Bank of Japan, we're getting nearer and nearer the hawkish / tighter policy shift. It has been and will be extremely well telegraphed. There was a good piece in Reuters yesterday suggesting, which you can view on PiQ Suite for free with no paywalls. Going through about the fact that the Bank of England and UAIDA are they've already spooked the market a few times now, and they definitely won't be looking to do that in future because they've had, I think it was, is it 16 years or something like that since the last hike or something stupid like that?
Yeah, it is going to be something like that.
Yeah. There's traders out there. Well, there's probably quite a lot of traders out there that have never experienced a Bank of Japan hike, which is quite unbelievable.
You have to be your age to experience
any sort of hike at all for a long time.
Oh yeah, true. I think Bank of Japan are off probably. The yen / Bank of Japan JGBs are probably the ones that are going to offer you the most potential for some volatility, because even though they're meant to be telegraphing the moves, yen and JGB are just so fucking wire hair trigger on any moves that they'll just go anyway. I think it's going to be the next few days probably not so interesting unless you really want to analyze or overanalyze the language used. But I think Q1 we could see some really interesting moves. I won't go too much into it because I know that's what we're going to talk about at the end about our predictions for 2024. But if just to looking at central banks as a whole, I think the order will be in terms of cutting. I think it'll be ECB, BOE, then the Fed. I think obviously we know the Bank of Japan is on a completely different path. Best of luck to them. That's all I've got to add, really.
Well, no, that was very comprehensive indeed, Ryan, and thank you very much.
Why do you sound so surprised when you say it like that? I don't, I deserve better.
Okay, Ryan, that was incredibly comprehensive.
Thanks,
well done, my friend.
Thanks.
Right, in that case, we are at the halfway point in the show, so let's get on to the third round. Right, some housekeeping first. The scoring system this week seems to have more of a mind of its own than usual, so I'm giving up on it in the last couple of rounds, considering that it's basically a tie.
Yeah, I saw you and have 25 points just now, and then he shipped me.
I've no idea what's going on, and computers aren't my strong suit at all. So we'll have to leave that one and park that, and hopefully give it a rest over Christmas, and it'll come back in better shape in the new year. What I do want to talk about, though, is obviously this is our last show of the year, so it is a pretty good time to look back on the last 12 months. Not only the last 12 months of trading blows, but also the last 12 months of sort of themes and moves and memories from the markets and macroeconomics over the last year. So while Ryan does his fancy dress there, Arno, why don't you kick us off? What would you say? I don't know, give us your top 2 or 3 market and macro highlights from 2023 that you think tell the story of the year that's just been.
Well, I mean, to sum it all up, higher for longer was definitely, the key theme. Some of the bigger surprises, though, was, I think, firstly is the not a bank crisis that we had in March. That was
bank crisis that never was.
Yeah, exactly. Yeah. That was quite entertaining back at the start of the year. I think other big surprises. I think growth durability is definitely one of them. For the US this year, there was so many calls for much deeper contractions, much deeper moderation and slowdown. I mean, we hit close to 5%. It's been downgraded slightly with the recent update, but it's close to 5% growth when everybody was expecting, recession Q3, Q4. I think that was I would say probably the most pleasant surprise, this year, because there's so many participants out there who kind of they salivate over recession and the doom and gloom. It's great to see economies doing really well, so that was a very pleasant surprise. It's great to see economies doing well. So happy for the US. That was definitely a big surprise, especially if you look at the data we had in Q1, Q2. So that was a big one. Yields was another surprise to me from a market perspective, or let me rather say the move in bonds. I anticipated weakness at the start of the year, but more strength going into the back end of the year. I think that issuance downside, that last big push lower in bonds, that was quite a surprise as well. And then I would say the last one is probably China. Not the lack of rebound, but I would say I was quite surprised by the CCPs. How willing they were to just see things go to shit, basically. Not stepping in more.
Eloquently put.
I've taught him well.
It's a technical term, but I thought they would have done more. I'm surprised that they just kind of let things go. They stepped in here and there with a few policy support measures, but we know it's all just smoke and mirrors. So I think that sums up the biggest surprises for me this year. That's 2023.
Well, 2023 in a nutshell. I'm not sure that was the 2 or 3 that I asked for. I do feel slightly sorry for the other gents now. Ryan, is there anything left?
What was the question again?
Your highlights from 2023, market-based highlights, let me stress.
I wouldn't say any highlights or lowlights, but just a few things that stuck out for me was that it was a year of extremes in terms of kind of geopolitics, rates, and all these kind of things come coming together, which was, for a lot of people, they wouldn't have had anything like this before, which was great, really. It's a big old fast learning curve. Something that I did note down, which is very rare for me, but the famous Keynes kind of quote, markets can remain irrational longer than you can remain solvent. I fear that after this year, I think it's more accurate if we kind of reworded it and say, you can remain a blinkered piece of shit longer than you should, because there was too many people marrying positions and marrying narratives that were just flying in the face.
2023.
And yeah, it's just, I think it was a very steep learning curve for many, and rightly so. I'm glad that I've stepped out of the markets a little bit, to be honest, because I think I would have done my absolute kahunas on it. But yeah, I think it's been an interesting one. I think maybe one thing that kind of will have surprised a lot of people is how little geopolitics mattered. When I say that, obviously they matter, but I mean, there were some people expecting huge moves, prolonged moves in commodities on, Middle East blowing up, start the Iran-Ukraine crisis with the commodity, the agricultural commodities. Yeah, we have initial moves, but very soon afterwards they all come back. I think that would have taken a lot of people by surprise, and I think that was a nice thing to see, that the elasticity of price.
That's a very fancy term for you to be using.
I'm not. I'll be honest, Michael. I'm not completely sure it was the right term to use, but it seems all right.
He's going to black out like in old school in a minute.
I think that is a good point, though. That it's been. And we'll come to you in a second, of course, but it feels like it's been a very noisy year. There's been a lot of headlines and a lot of chatter and a lot of data that at face value or in a textbook, you would say it should matter. But it's been, as you said, kind of blink and you'll miss it moves that realistically, it's one of those where if you weren't nimble and agile as a trader, it kind of taught the lesson, do not go chasing things, because you will end up getting your fingers burnt.
On that point, it was a really interesting chart. Well, I thought it was interesting.
There we go. You're really selling it.
It was on Bloomberg. It was basically based on trading strategies. And throughout this whole year, the trading model that outperformed everything else was buy and hold.
Wow.
Yeah.
Wow.
And the worst performing were stochastics and fear and greed.
Where was Elliott Wave?
I think that probably comes under stochastics or something.
It comes under the sole of my shoe most days.
That is actually really interesting. Go on, you take it away. What other memories from the year have you got?
I mean, going back to what Arno just said there on China, I think it's interesting that there was no interest in China or weakness in China. People just didn't care. And FDI fell for the first time ever in Q3, and so what? I think it's just one of those things with China that they always expect something to be bailed out. So and it doesn't matter how bad it gets, and they eventually they will, or they'll start a war just to I don't know, take the attention away from weakness at home. But I mean, other things that probably haven't been covered so far is AI. I couldn't believe how that became such a mainstream investment theme straight away, and some of the moves were just incredible. Looking at the worst performing sectors or the best performing sectors of this year were basically the worst performing sectors of 2022. So YOLO and meme stocks and AI were the best performing sectors, obviously along with mega cap tech, and then the worst performing this year were defense and commodity sensitive stocks. I think what was interesting, again going back to what Arno said about yields, bond proxies have done absolutely nothing for 2 years. That's something that might be worth looking into in the new year. With rates themselves, I think corporates look to shelter themselves from rate hikes. I mean, I did see that Fed data, the net interest payments for US corporates were basically the lowest since 1978. So they've basically locked in that debt at cheap funding rates, and they've invested that cash then to higher interest income as the Fed has gone through this cycle. But that's something that will have to be looked at next year, as well as the mortgage payment cliff in the US and the UK is well. We won't talk about that because obviously we're going to talk about 2024 in the next segment. Yeah, I mean, they're the a couple of the things that I looked at outside of what my learned gentleman friends were.
Who are they?
Yeah, I was going to say they must be on a different show that you're doing somewhere else.
I'm talking about Mike and Arno.
Right, well, why don't we do that? Why don't we get on to getting our crystal balls out and having a look at Right, so it is coming close to the end of the year, and of course, everyone on the sell side has already published their 2024 outlooks, which probably by mid-January are going to be in the recycling bin or a bonfire somewhere. Let's see if our predictions for the year ahead can age a little bit better than those. Ryan Paisey, why don't we start with you? Go on. What are your thoughts on what 2024 might hold for us all?
Are you asking me to get my crystal balls out?
No.
Okay. So key themes for 2024. I don't know. PiQ Suite taking over the world. I think, in a nutshell, policy divergence is going to become front and center. Obviously, at the moment, it's all prepping for the divergence. I think 2024 is obviously where it's going to happen. So there should be lots of opportunities there. Geopolitics to remain front and center. Again, as we just discussed, though, the reaction function of markets is changing and evolving. So it's not just, go and then go again. We've got to look for kind of volatility around it in both directions. Personally, I think that the Middle East, well, I don't think that will have such a big impact on the markets unless the Yemen bit with the kind of going through the impact. So I'll start again. The Yemen impact on the shipping lanes going as it comes up through the Suez Canal and all that, the Red Sea, that has the scope to be more damaging than anything else, rather than kind of the Israel itself kind of situation. But who knows? I'd be more looking towards China, North Korea area for possible things that could pop up. We're seeing some quite kind of aggressive rhetoric from South Korea this morning, so I think that can only get worse over the year coming forward. Continued degradation, of EU political bloc. I think we're going to see that fracturing more and more. But for equities, path of least resistance remains higher. Will probably stay higher. I've got a question for the room.
Go on.
Because obviously it's going to be my last. Well, hopefully for you guys, my last statement of 2023. What curveball do you think we could see? I know it's not a black swan if you fucking predict it. We all know that, bollocks. But if you could pick a curveball that no one really is talking about for 2024, a real kind of outsider, have you got anything in mind, or what would you suggest? I'll tell you mine.
Oh, go on.
Mine, I'll give you time to kind of think of one. Mine is a ransomware attack on a significant entity, be it a clearinghouse, a central bank, or an exchange.
What are you working on?
Pardon, sorry?
What are you working on?
What do you mean, working on?
Ryan's going to go back to being
I can't. I struggle with Control C, Control V, ain't me? I think that's my curveball for 2024. I think we're starting to see more and more of these ransomware attacks, and we've seen them on the CIBC that impacted the treasury market. We did see them on a clearinghouse during the year. I'm not saying it's something that I expect, but it would not be a surprise to me if we did have something major on a major entity that impacts global markets. But I'd be interested to see what you three have as your curve for 2023.
On that point, I think, like from a technology standpoint, I think something big will probably happen in our AI that will deal with the national security crisis somewhere.
Oh, interesting.
That's a good shout. Arno?
Yeah, I second Ioan there. I wanted to say something AI related, but something, we've obviously had a lot of concerns about these special projects these guys have been working on and how potentially detrimental that can be. But I think something that's not looked at is how governments can use this to other governments' disadvantages, So I think something happening like you say in terms of ransomware, that's
I'm obviously using ChatGPT wrong because I'm asking it to write Christmas cards for me.
Merry Christmas.
Michael, what are you thinking?
Mine is nowhere near as interesting as that, I'll be honest. But I actually think deflation could be the biggest.
Jesus.
Because, no, we already see it in China. Look how quickly price pressures are fading in Europe.
That's not a curveball, though. I said a curveball.
Well, it is a curveball if central banks have still got rates at 5%.
Oh, yes,
and they're saying they're only going to cut 50 basis points next year.
What about
suddenly you're looking at 3 or 4 times that.
Yeah, true. But yeah,
and I would almost argue that actually the risk of it is probably higher than most would think, because central banks and the ECB are actually a really good example of this. They are still scarred from 2021, where they were saying everything's transitory, we don't need to do anything, we underreacted. So there's now probably the risk that they actually overreact and keep policy arguably too restrictive for too long, because they're saying, we really want to make sure inflation is beaten, and actually forget the lagged impacts of the tightening and obviously what's happening with growth and all the rest of it.
Here's another curveball for Ryan anyway. I think the EU will actually sign the Stability and Growth Pact.
No, now you're just being silly.
Not signed what, sorry?
What?
Right, well, God, there's our curveballs. I mean, Ioan, is there anything else you want to add on next year in a couple of minutes?
I think eventually we will see the US consumer slow down. That Bitcoin ETF will be interesting if it does come to fruition. I think it'll be. I think we'll see a spike and then a dip on approval. I think it's one of those sell the event type things. Gold will be interesting again. Central banks. Central banks have been loading up on it, and it'll be interesting to see, what happens there. Oil probably trades above $100. Dollar index below. I'll tell you what, I'm really interested to see what happens to Argentina next year.
Yeah, that'd be interesting.
Yeah,
really, really interested.
Purely from a spectator sport and also a possible holiday destination.
Well, hopefully brings the chainsaw out and everything, it's just...
It's going to be interesting to watch that as an observer. I'm not sure I'd want to watch it on the ground. Let's put it that way.
Well, unless you're flying over with a little mojito in hand, maybe.
Yeah. Some good red wine for very good value.
Yeah, exactly.
Next year. Arno, what about you, mate? Any final closing thoughts on what 2024 might bring?
I think we've mentioned most of them. The one we haven't talked about, to my absolute regret of not talking about it, actually talking about it, is US politics. Obviously 2024 presidential election is going to be...
I forgot about the election.
I'm already regretting everything that we're going to get, the back and forth from markets. It's the only thing that financial media will talk about. I mean, I have no time for it, but the markets will focus on it. It's going to be a key focus, especially the fiscal side. 2025 is going to be interesting, especially based on the decision, because there's a lot of fiscal stuff going on. We've got the debt limit in focus. I think the tax cuts is coming up for a new decision in 2025 as well. Mm-hmm. So for now, based on what I've read from those that know a lot more about US politics than I do, is that it seems like a Republican victory for now will probably be the most market-friendly winner. Obviously, that can change as the empty promises change, of course. But yeah, I think that's probably the one we didn't cover. To my regret, I'm not looking forward to that at all, though. I've got no time for US politics at all.
Well, the other thing I think will be like a big curveball is that by March, Arnold will have an Aussie accent.
Oh yeah, come up with a hat with a load of corks dangling on it.
Oh no! Right, well there you go. There's 2023 and 2024 in a nutshell. That does bring us to the end of the show. We're not going to bother with scoring because God only knows how many points everyone has got.
Me and you won.
Yeah. Thank you very much to the gents for joining me this week. Arno Venter, Ioan Smith and Ryan Paisey. Thank you to them for joining me throughout the year. And of course, thank you as well to our very good friends, Adam Linton over at News Squawk and Richard Matthews at One.io, who are not with us today, but will be back with us during the new year. Thank you very much as well to Kyriakos, our producer, for bringing this together and doing a ridiculous amount of editing to cover up our mistakes and inappropriate comments throughout the last 12 months. Right, before this turns into an Oscars acceptance speech, we will leave things there. Thank you very much for watching throughout the year. Have a very, very Merry Christmas, a Happy New Year, and we will see you again early in January. Thank you for watching. Goodbye for now.
Goodbye.
Cheers, guys.